Perfect. Okay, cool. So I will kick it off. Hopefully you guys can all hear me. Matt, since I see you on the screen, just give me a thumbs up that you can hear me, and perfect. So thanks for joining us, guys. We are here to discuss the power of crypto derivatives. We're joined by three great industry leaders. Alan, who spent 20 years in the traditional side of the business, jumped into crypto last year. He has experience at CS, Bear Stearns. Most recently, he was at NatWest. He was the COO of SDM, and then recently helped launch Secure Digital Markets Financial, which is the derivative arm under SDM. Joe Dillon, who's the CEO of Adicon Energy. He used to run Honeywell Global Demand Response Program. He understands the industry very, very well. He also spent time in the industry at one of the largest miners at US Bitcoin Corp, and he spends a lot of time deciding custom strategies for miners. Matt Williams, who is the head of derivatives at Luxor. He was part of the team that launched the Bitcoin futures on the CME, which is really awesome. And he was also at the NFA helping to find their tech and innovation strategies. Since his time at Luxor, he's launched a few hash rate derivatives. Maybe we'll kick it off, Matt, just a quick icebreaker and go to the other two just to let the audience know how you actually got into crypto.
Yeah, thanks. First of all, thanks for having me. Appreciate the chance to talk. So I started in crypto back in 2017. So at the time, I was at CME Group on the corporate venture capital side of things. And the group, we had a small group within that focused mostly on fintech, and fintech at the time was crypto. So we were looking at launching a Bitcoin future. So the team that I was working on started kind of doing some research on it, doing a lot of education around the space. So a lot of what we did was go around and talk to institutional players in TradFi about, what is Bitcoin, doing a lot of one-on-one, talking about the risk, talking about the volatility, and then, trying to come up with an appropriate strategy to launch a futures instrument around it. Since then, I joined a corporate venture capital arm of CME, and we had done a lot of investments in the digital asset space and just kind of carried it on through there. Joined Luxor about a year ago. And here I am trying to build some hash rate derivatives. So far, so good.
Awesome. That's an amazing story, Matt. Joe, I'll kick it off to you next. How did you get into crypto?
Sure. Yeah, I think I probably started paying pretty close attention around 2020 or so a little bit later than Matt. I had been finishing up doing some commercial real estate development work and was kind of trying to catch my breath a little bit. Obviously, that was a pretty tumultuous time then. And so, kind of dug in on, what is this Bitcoin thing? How does it connect to real space and real markets? And then kind of dove pretty deep on the electric side and just realized there's a ton of unoptimized opportunities to use this as a grid scale asset. And so, since then I've kind of gone full 100% of my attention, full focus on, how to deploy those grid scale reliability strategies to really optimize the economic value of the data center as a whole. And so I think that view has grown and changed a lot in the last 2 or 3 years. And I think we're still pretty early stages. So pretty exciting time.
Fully agreed. Alan, you're up.
Hey guys, good morning. So for me, I'd say early 2017, I started learning about blockchain technology and trading some Bitcoin just from my PA. And then I think over the course of that year, working on a trading floor at a big global bank, Wall Street Bank, I noticed that a lot of guys were doing the same thing, trading Bitcoin, talking to my clients, everyone's starting to talk about it. But I think the real call it catalyst where I knew it was for real. I went over to late 17. I went over to Tokyo for a business trip, and we had a big roundtable with some of the CEOs and CFOs of the Japanese mega banks. And at the end of the roundtable, I asked the question, how many of you are thinking about or getting involved with crypto or Bitcoin for the firm? And I was actually surprised. I think about 2 out of 10 actually said yes, they were, which 2 out of 10 for me, 20% is actually a very large number, especially for the Japanese banks, which tend to be a little more conservative. So when I came back from that trip, I explored starting a crypto trading desk for the bank that I was at. So I did a lot of research, spoke to a lot of people in the industry, put together business plans. Ultimately the plan got shut down, I should say. But that was kind of my first real professional foray into it. And then when I left Wall Street a couple of years ago, I knew what I wanted to do, and it was the prime time to make the move into crypto.
That's awesome. I'm going to start off, Alan, with a question for you. But before I do, real quick housekeeping. If anyone in the audience has any questions, bottom right panel, you hit the questions button. You can type to us. We're going to save all the questions for the end just to conserve time. But we'll see your question and can queue it up. So, Alan, a lot of people in the audience have never traded derivatives before. Can you give us a brief overview of the types of derivatives and especially as they relate to crypto?
Sure. Yeah, I'll keep it at a pretty low level or high level, I should say, just because a lot of the audience members could be new to derivatives. The first thing is mentioned briefly, why do people want to use derivatives instead of just say spot? And I think it comes down to 5 reasons. One, hedging. People want to protect downside. 2, yield enhancement, where investors are looking to gain additional yield, and you could do that by selling calls, et cetera. We can talk about that afterwards. 3 would be leverage. For every say dollar you invest, you can get maybe 10x or more of leverage. There's obviously speculation, and then there's alpha, generating alpha by trading around the vol surface. In terms of the types of derivatives, very similar to TradFi space. You have listed derivatives, which are listed on the exchanges, and you have OTC or over the counter, which are bilateral negotiations between 2 different counterparties. The listed derivatives are obviously standardized, with expiries and strike prices and things like that. And while OTC can be very bespoke or very customized, and that's the benefit of trading OTC derivatives. In terms of the specific products, very similar to TradFi. There's futures, there's options, there's non-deliverable forwards, there's total return swaps, there's CFDs or contracts for differences, and then there's customized or structured options as well, or structured derivative positions you can do. In OTC space, OTC are typically governed by ISDA or CSA globally, which is the same thing in TradFi. And I'll stop there, but obviously we'll open up for questions later on if something's not covered. But just as a side note, at SDM Financial, we put out a derivative primer focused on options about a month or 2 ago. For anybody in the audience that would be interested in it, just reach out after the webinar. I'd be happy to send it over to you. It's easy reading. We try to stay away from a lot of the math, but please reach out if you're interested in that.
Perfect. Thanks. Matt, being at Luxor and being one of the first in the space to offer certain types of derivatives products, obviously Bitcoin miners have very specific risks that they're exposed to. Can you talk a little bit about inherent risks miners have and your thoughts around some of that?
Yeah, thank you. I think it's important when you think about Bitcoin mining and hash rate that you view it as a commodity. At Luxor, we view this very much as a commodity. So when you think about risk, you can kind of draw anecdotes and tangents along really any commodity space, be it energy that Joe will talk about, or, even like my former career of being in the ag space. You have a lot of different risk exposures as an operation that you need to manage. And miners are no different. At a high level, I'd like to say that they have 3 main risk exposures. The first one, obviously, is Bitcoin price risk, plays heavily into the success of an operation. The second one being their energy risk, how much it costs to run their operations from an energy perspective. And then third is their hash rate or hash price risk, which is really directly tied to the revenue. So And then also, like, beyond those three main risks, miners are also have risk exposure to ASIC prices, what their hardware costs are. They have exposure to hosting arrangements. They have regional policy risk and a bunch of other nebulous areas, which makes it, as an operation, very difficult to hedge. So it's why we like to say it's very important to hedge where you can. So, to that point, in Bitcoin, there's, as Alan said, there's a bunch of derivatives that exist to manage your treasury risk. There's futures, perps, swaps, vanilla options, costless collars, and then more exotic structured products. And then for energy, there's a bunch of different derivatives for crude oil and nat gas and electricity. And energy is a fully mature space when it comes to derivatives. And then even beyond that, you have things like PPAs and offtake agreements. And all those are designed to give miners certainty around their energy costs. Now, when you bring it back to hash rate, historically, you haven't really had many options to hedge your revenue risk. So as a miner, your revenue is tied to Bitcoin price. It's tied to difficulty, which is how hard it is to mine, and is also very important. And then lastly, transaction fees, which is very, relevant lately with the introduction of ordinals. So those three things combine to form hash price and what the expected revenue is you can get from your hash rate. And so with that in mind, those are the main things that you need to hedge as a miner.
Yeah, fully agreed. Matt, you hit on energy pretty significantly there, as well as hash rate, obviously. Joe, you spent a lot of time in this space. Can you give us a little bit of an indication on the risk, obviously, that miners face in regards to the price of energy, and how miners should think about hedging this risk?
Sure. And I think there's, just to kind of table set this, I think something that's probably not super well understood yet is that miners operate as a long volatility asset on the demand side in electricity networks. And it's currently really the only time we've been able to build these at scale, right? So historically, your demand side is short volatility. You're always going to run your AC, and all of your long volatility is on the generation. And so as much as it is a risk, it is an opportunity. So it's a lot about designing your strategy around at what point do you want to accept monetization from the grid during periods of volatility instead of accepting monetization through hash price. And that goes back to how you cite your location at the beginning, right? If you're very really feel like you have your arms around hash price, you may just take a straight tariff rate and have a very firm defined operating window. And if you really want to maximize the arbitrage between the two, you're going to be, running some pretty sophisticated hedging strategies in the more deregulated markets. And so it is a bit of a spectrum, but I think it's important to understand that, the knife does cut both ways. You can use it as a tool to improve your economics. Paired with that, you have to have the operational and power marketing bench depth in order to be successful at that.
Yeah, fully agreed and understood. And obviously, Joe's a great resource that if you guys do have questions on this, feel free to ask in the chat, and we can address it at the end. So Alan, Joe talked a little bit about volatility as it relates to energy, but overall in the space, right? Bitcoin is historically one of the most volatile assets. A significant price drop seriously affects miners' bottom line. We saw that a lot last year. What are some hedging strategies that miners can undertake to using derivatives to hedge out this price risk that they're facing?
Sure. I would say there's four things, right? And I think historically, miners have done the first one, which is don't do anything, right? Bullish, obviously, on the sector. They think Bitcoin's going to keep going up. Don't do anything. Now, obviously, we saw how that ended a year ago when Bitcoin went from close to 70 down to 15 or so, and most of the miners did not have hedges on, or were definitely under hedged at a minimum. So the second choice, or the first real choice of hedging, is you could sell futures. Now, if you're selling futures, it's I'll say almost like a perfect hedge. If you're selling futures right around where spot's trading. Now, the good thing is it's a good hedge. The bad thing is that you're giving away any upside potential. So if Bitcoin went from 30 to 50,000, you're locked in at 30, and there's no upside. So our recommendations are usually one of the next two. One is buying puts. And if you're buying a put, you're hedging against your downside the downside of Bitcoin, and you're paying a premium to do so. The good thing though with buying puts is that you still maintain most of the upside. So if Bitcoin's trading at 30,000 and you're buying a 30,000 put, Bitcoin goes up to 50 in the example I just mentioned, you're still participating in most of that upside, except the premium that you're paying for it. And the other strategy is selling calls. And by selling calls, effectively what you're doing is, and selling out of the money calls, you're effectively generating yield, and you're participating a bit in the upside. So if the market rallies from say 30 to, just say you're selling 33 calls and you're at 30,000 right now, you're participating in some of the upside, and call it 10%. And then the premium that you're getting for the calls, you're collecting no matter what also. So if the market goes higher than the strike price, you're selling at the strike price, which for miners it's good because they're generating X amount of Bitcoin on a daily basis, and they need to sell X amount also to pay for operating expenditures. And then the opposite happens. If the market stays here or goes down, at least the miner is collecting the premium, so that helps insulate you against any downside losses. And then finally, there's a lot of bells and whistles you can put on any of these products. You could do collars where you're buying a put and selling a call, or you can do a put spread where you're buying an at the money put and selling an out of the money put, or what have you. So there's a lot of different bells and whistles you could put on it, but generically it's selling futures, buying puts, or selling calls.
Yeah, that was a great overview, and obviously something needed in the industry. And I think a lot of miners are really focused on that after all the risks that we saw in the market last year. Matt, earlier you talked a little bit about hash price. I want to dive into that a little bit more. Can you talk about exactly what hash price derivatives are, and how miners would use this product in their hedging strategy? I know Luxor was one of the first, if not the first, to launch this product, and you were obviously instrumental in that. So maybe just start with a quick overview, give us an indication of both sides of the market, and whatever else your thoughts are around that.
Yeah. So if you'll bear with me, I want to tell a stupid anecdote real quick before answering this. So recently we did a promo video based off a panel I sat on, and we did a recording of the video, and we used AI to kind of transcribe, and AI, makes mistakes, and it said, it misunderstood me, and it said hedgery, and ever since then I've decided I'm gonna coin hedgery. So here I am on your webinar, officially coining hedgery. So I want to promote miner hedgery, and I think hedgery encompasses everything that we're talking about here. But to your
there we go, hedgery trademark to Matt Williams.
Luxor and hedgery and Matt Williams. But anyway, to answer your question, how do hash price derivatives help miners with their hedging strategies? So Bitcoiners produce hash rate, as I mentioned before, as a commodity, and hash price is what they're compensated for that hash rate. So historically, miners have really only looked at hedging from a Bitcoin price perspective, and I do think that's relative, but it's not entirely sufficient to account for the total exposure that they have in their operation. So as I mentioned before, hash price encompasses all the aspects of the miner revenue. So the block reward, difficulty, transaction fees, and Bitcoin price. So the forwards that we developed are hash price forwards. They're either USD or Bitcoin denominated instruments, and they settle to an index that we produce. And what they do is they allow participants to trade hash price really without the actual, since it's cash settled or Bitcoin settled, without the requirement to own that hash rate. So as a miner, you can use this product to lock in hash price for a given amount of time and a given amount of hash rate. So say, for example, you're a miner and you have 100 petahash that you want to lock in, and you find today's price is $74 attractive, and you want to lock it in for 3 months. That's what our product is designed to do. So it reduces your exposure to price, difficulty, and transaction fees. So in this scenario, you've locked in that 100 petahash for a given amount of time. And if there's an adverse move in hash price, you're compensated in USD or BTC. And others, and that's a minor example. Typically, there's on the sell side, there are some natural buy side use cases as well. But really, what this product does is give synthetic exposure to hash rate without actually having to own any equipment. and, just to kind of close out your question, we offer a regulated structured instrument. It's OTC, like Alan mentioned, and there's benefits to that as well. And, low counterparty risk, liquidity, and hash price transparency all kind of contribute to an instrument that helps you with your hedgery.
Perfect. Love it. Love the hedgery. Obviously we know the crypto market in general, the market cap fluctuates around $1 trillion, sometimes as high as several trillion when you're in a bull market. But as far as the derivatives market, right, how would you size the derivatives market? Alan, we'll start with you. With crypto derivatives, what would you say, the demand is and how large the market is in general?
Sure. So it's funny when I'm talking to some of my ex-TradFi colleagues, they're shocked by how large the market is overall. And to give everybody a sense of the amount of daily volume going through or monthly volume, the spot and derivatives combined, right, on exchanges for April, right? So it's pretty recent data. It was $2.75 trillion. Okay, so $2.75 trillion for spot and derivatives have traded for the month of April. Out of that, about 75% has been in derivative form. Okay, so over 2 trillion have been in derivative form. So there's tons of liquidity out there for derivatives, and obviously the derivatives, like I mentioned earlier, it includes futures, quarterly futures and perps and options as well. But it's a huge amount. 2 trillion trading a month. It's a huge amount, tons of liquidity. And obviously the liquidity is there both on exchanges as well as OTC.
Wow, that's a pretty big market. Matt, as far as hash price derivatives, right, the product you guys launched and are managing, how big would you say that market is?
Yeah, so it's a bit trickier. Alan is fortunate; he's got some years of data points. I have months. We've really just kind of officially launched in January, but to do some. If you want to talk about the total addressable market, and we can kind of work our way down from there. Network hash rate is sitting at roughly like 360 exahash right now. Hash price today, I think, is somewhere around $74 a petahash. So if you take the total network hash rate, at current hash price, it's probably close to $1 trillion on a per month basis at current hash price. Obviously, they could go way up with hash price or down further. And we're also, there's no expectation that miners are going to hedge all 360 exahash out there. So it's obviously a subset of that. But, from our own perspective, since January, we've experienced tons of growth from a liquidity perspective. On both sides of the market, we're approaching, almost an exahash in size. And I expect that to keep doubling every couple of months as more and more participants come on. So, and then lastly, like when you factor in people that are coming in to use this instrument, not strictly for hedging, but as a synthetic exposure to hash rate, both from a long and short perspective, I think that'll increase the market size significantly, both from like a market participant perspective and volume. So, it's hard to gauge right now. I think the sky's the limit, but definitely growing at a rapid pace.
Yeah, fully agreed. Well-needed product, and adoption's only going to go up from here. Joe, what about from the energy derivative side? How big would you say the size of the market is?
So, we kind of let's kind of paint a picture here in Texas. If you're at call it 75,000 megawatts of load, and all the electrons are only sold once. That's about $3 trillion a year of notional from that one grid. And obviously there's a very active trading market there. I think where it gets interesting on liquidity is, a lot you'll find in each of the individual markets that trade on ICE, they tend to focus in on, in Texas, it's Houston, Dallas, population center hubs where you find the deepest trading liquidity. And as you get out into kind of more remote spaces, you really kind of start running into you're having more bilateral agreements rather than a kind of a liquid product. And so that topology matters, I guess, a little bit, but you can always kind of hedge back to the hub. And so it's a little different there where it kind of varies on where you are. But at the end of the day, there is, you effectively take your basis back to the hub and you hedge out there, and you can get access to more liquidity than the market can use.
Yep. Fully, gives a good picture of the total size of the market from the three of you. So appreciate that. We're going to jump into our Q&A section, but before we do, just want to put a slide up. We might not be able to get to all the questions that were asked. If you guys have any follow-up questions, you can feel free to reach out to these three gentlemen. Their Telegram is on screen, or you can always reach out to us at Secure Digital Markets. Our contact information will be shared after this, and you can find it on our website, and we can put you in touch with any of these three guys. With that being said, Alan, I'll maybe structure this first question that's coming in to you. Are there any types of structured derivative strategies for crypto, and can you provide some examples?
Sure. Yeah. So the structured, it's a very good question. The structured product market is actually growing very, very quickly in this space. And I would say, some of the products out there, I would say, are in demand from both family offices and high net worth individuals, in terms of, like, say, structured notes, et cetera, but even from the mining community also. Some examples that are out there, I'll say from the family offices and high net worth, principal protected notes or defined outcome structures are very big. And just to give you a quick example of those, if somebody wants some downside protection, but they also want upside growth of, say, Bitcoin, they could buy a principal protected note that, just say, the first 20% of the losses they do not absorb, and maybe they'll get about 80% of the upside. And so something like that's a common one. But there's all different types of formats of those. Another one might be, okay, well, you won't eat the first 15% of losses, but you'll get 100% of the gains up to 30% or something like that. The other structured product that's pretty popular as well, called accumulators. And basically what they do is they're for investors that are looking to buy Bitcoin at lower prices than spot. And what happens is, so if Bitcoin's trading at 27 right now, they could effectively, what they're doing is selling puts, and they could get some other bells and whistles on it. But effectively, if Bitcoin goes lower, they'll buy more Bitcoin automatically. And it's a good way for long-term investors who are looking to get in and purchase Bitcoin or any crypto at a level that's better than spot. The mining community likes the opposite one. They like the called decumulators, which is a product that we're going to be offering over the next 30 days. And basically what they are, the mining community, you can sell, as opposite of accumulators, you sell at higher prices relative to spot. So if Bitcoin's trading at 27, if Bitcoin, you basically say can lock in 30,000. And by doing that, what you're doing is just say it lasts for 3 months or 4 months, the structure. If Bitcoin is below 30, you're selling 1 unit. If Bitcoin's above 30, you're selling, say, 2 units. And then, to make that work, though, to get the extra juice, there's usually like a knockout option embedded in there. So, for example, if Bitcoin goes down to 22, the trade would terminate. But we like these because those knockout options are pretty far away from spot. And like I mentioned earlier, the miners are looking to sell at better prices than spot is trading. So it's a good way for them to do this. And other structured products out there. I mean, there's everything under the sun that can be created. Anything with barrier or digital options or knockouts or range accruals, what have you. We could put anything together for our clients. But like I mentioned, though, the structured product market is growing exponentially, and we're getting inquiry all the time.
Yeah, fully agreed. And not to isolate just to the miners, right? But even that decumulator product that you talked about, if you have the view that the market's going to chop sideways, and you're a high net worth investor, maybe you want to get some premium on it, we can obviously structure for people like that, right? Which a lot of people seem to have this view, especially as we're rolling into some of the macroeconomic conditions that we're all facing. So I have two questions in. Matt, I'm going to double them up and gear this one to you. You talked about Bitcoin miners using hash rate derivatives, but what are the other market participants trade these instruments and why? And also, what are the inherent risks with utilizing hash rate and energy derivatives? Joe, you can feel free to chime into it on the energy side.
Yeah, I would actually, for that second question, I would imagine Joe and I's answers are going to be the same. But I'm going to kind of piggyback on something Alan said. Well, first of all, like the number one thing we get asked in this space is like, who's on the other side of this? Because obviously the miners are on the sell side of this, using it as a hedging instrument. But, similar to a structured product where you're trying to buy Bitcoin below spot, hash price is similar as well. So like we have people that are coming in on the buy side of this, and given that there's more sell side pressure than buy side, there's an expectation of a discount to spot. And so effectively the buyers of this instrument are coming in and getting hash price below spot levels and at longer durations. So, it's not traditional yield, I would say, but they are effectively getting yield on hash price, which actually, will turn into Bitcoin as well if you use the BTC denominated contract. There are some natural use cases in the buy side as well. So a miner hosting company, we have people that are using our forward to effectively hedge their fixed payout arrangements that they have with miners because they have exposure to the upside, specifically during periods of curtailment or downtime. We, not surprisingly, we have a lot of miners that come in and use this instrument for synthetic exposure to hash rate. And this could be, while they're waiting on ASIC purchases or trying to find hosting space. And then we're increasingly seeing interest from institutional participants such as hedge funds and family offices and OTC commodity desks. So while it was designed to be a hedging instrument, it gives people the ability to get exposure to Bitcoin mining actually without the complications of owning physical equipment. And that's a lot what we see from the buy side. In terms of your risk question, in what we've seen in the last 12 years, counterparty risk, especially in the OTC space, is the number one thing that you have to worry about. You have to get comfortable with the people that you're trading with, especially in a bilateral environment. And so, when we designed this product, we had that very much in mind. So we have very advanced margining and variation margining capabilities. We do everything in a regulated fashion. We report our trades to the CFTC. We, paper everyone through an ISDA, and, it can be somewhat complicated to onboard people, but we want to give people the trust to work with us, as a counterparty. And so, yeah, I think the scariest thing when trading derivatives is kind of, managing your risk and also what your counterparty risk exposure is.
Yeah, fully agree. We got another question around that, and I think you answered that pretty well, right? I mean, everything in the crypto space, especially as it matures right now, is bilateral OTC, and we did see a lot of inherent risks last year. But I think doing everything regulated, structuring it similarly to the traditional side, which you guys all have experience in, is probably one of the best ways to manage that risk. Joe, I'm going to gear up this next question to you. What are some common hedging strategies successful miners are using today, and how do you think that will evolve over time?
Yeah, thanks. I think so. Both to, from Alan on a product sophistication level, I think that exists there in the in-game on the power markets, but we are probably at the very beginning of that kind of hockey stick of complexity, right? Currently, you have, I would call it two classes of large scale miners. They're either not committing the capital to take a fixed position, and so they may play around a little bit with options, but are generally just running their curtailment against the live price. That obviously wears a ton of risk on the operation. I think you've also seen a reasonable number of them that have kind of survived the last couple of years have some kind of block exposure where they'll buy a block of power and kind of operate and hedge around the margins or liquidate that block when, power prices are extremely high. And then when, they'll keep a little bit of capacity. So when power prices are low, they can get a little bit of that upside of lower prices. I do think you're going to see, and we're starting to see, a lot more interest around how do you get more complex with duration, length, options, collars? Like that's all kind of working through right now. And I think a lot of that, to Matt's point, comes back to the counterparty risk piece, right? So, these power trading desks are putting, have a material exposure to the market, and they need to make sure that their counterparties operate effectively. And this is really kind of where the rubber meets the road, where you're actually settling the financial with physical in the power markets, which is a bit of a unique spot. And so I think there's been a lot of really strong improvements on what kind of software systems you're using, as well as, even physically at the locations to improve that trust level of counterparties. And I think that's going to lead us to having much more sophisticated responsiveness to grid messaging, grid prices. We're still probably 3 to 5 years away from seeing battery level, sub-cycle level response. But I think as far as a fast following load that you're going to see pretty consistently chasing selling the peaks and chasing the valleys, I think that's here and now. I think you're going to see that deploy this year. And so I would say that products structured around leveraging that to maximize the total value is, kind of where we're going to be walking through the rest of this year and into next year.
Perfect. That was a very, very in-depth answer, and I appreciate it. Alan, I'll gear this question to you. Why would someone use an OTC desk for crypto derivatives instead of using an exchange?
Sure. I think there's multiple reasons. One of them I mentioned earlier. You can create customized products with OTC desks. Whether it's a structured product like I mentioned earlier, or just customized strikes if you're trading options or expiry dates, etc. So that's A. Two is you know your counterparty, right? You know exactly who your counterparty is, and hopefully that the firm has a relationship with you. And you're, you've done a thorough credit review. Unlike, last year, you think of like FTX or some of these other exchanges that went belly up. You don't have that risk there either. And like I mentioned also, each of the derivative transactions, at least the ones that we are involved with, have ISDAs and CSAs, right? ISDAs and CSAs, for those who are not familiar, are standardized global derivative agreements that have been around for, I'll say 40 years. It's probably at least that in TradFi space, and they've just tweaked them a bit to include crypto derivatives. So I think for all those reasons, it kind of makes sense. And also too, I'm going to say you kind of get better liquidity also. If you're trading on one exchange, you'll get the liquidity just of that exchange. If you're trading with an OTC provider, such as us, you have many, and we have many outlets, right? We can go to obviously exchanges to hedge, but a lot of times we're hedging with other clients that we have on, just as any market maker would do, or even other liquidity providers.
Perfect. Yeah, fully agreed. I mean, we talked a lot about risk, about knowing your counterparty, and I think that was a great answer. I think that's that summarizes the majority of the questions that we've got inbound. We will circulate this recording as well as the three gentlemen's contact information for anyone else that has questions, or if we didn't get to your question. Matt, Joe, Alan, I really appreciate your time and want to thank you for joining us today.
Thanks for moderating, Krishna.
Yeah. Thanks
guys.
for having us.
Thanks the whole team. It was great. Really enjoyed being here.
Likewise.
Great. Thanks.
Thanks, guys. Bye.